It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Tuesday morning. President Trump cut short his G7 visit while calling for an immediate evacuation of Tehran. Those comments rattle markets, stocks dip, and oil jumps as the Israel-Iran tensions persist. And readying for a slog, Senate Republicans released their blueprint of the big, beautiful bill, deepening a rift with the House's version. It was risk on yesterday. It was a rally in stocks with no escalation in the Middle East. That changes from the words of President Trump denying that he is working on a ceasefire, saying that Tehran should evacuate. You see a slight dip this morning. Nothing too dramatic. We're down about 0.5% for both the S&P and NASDAQ futures. By the way, with yesterday's rally, we're still within 2% of the all-time highs. Oil, though, that takes a leg higher, basically the inverse of what we saw yesterday. So with that move, we are unchanged on the week for Brent crude. It's higher by 1.4%. And finally, a bid coming into bonds. This is something we hadn't seen throughout the conflict. I should be clear, the bid is very slight, basically unchanged on your 2-year yield to about a basis point lower. Same goes for your 10-year yield at 4.43 this morning. Let's get you some stocks to watch. What's moving underneath the surface? With that is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So we are seeing significant weakness in renewable energy stocks today. Take a look at some of these moves. Sunrun down 27%, Solar Edge 21%, Enphase 17%, First Solar down 9%. It's all to do with the big, beautiful bill, as Danny just mentioned there, and it is around the renewable tax credit, set to end sooner than expected, potentially going to end as soon as 2028, according to that detail in the lines on that bill. So keep an eye on that sector today. Then over in telecoms, T-Mobile significantly weaker as SoftBank sells a lot of stock. Now they are looking to move out of some of their telecoms investments and put it into AI, much more of a sexy kind of space to be in for sure. But that stock down around 4% today. And then over in gene therapy, I had to Google this one. I understand it is related to DNA editing, but there is a report in the Financial Times that Eli Lilly is going to buy Verve Therapeutics, and that stock rallying almost 90% on that report in the FT. And as usual, check out on the Bloomberg terminal the Before the Bell opening wrap for a summary of all these news and more.
Joe, thank you so much, and we'll catch up with you later this hour. Also this hour, in just moments, we'll be speaking to Mark Dowding of RBC Bluebay on how to handle risk. Later in the hour, Torsten Slok of Apollo on how oil may change the inflationary outlook. We'll also catch up with Virginia Governor Glenn Youngkin. He'll be joining Guy Johnson live from the Paris Air Show. Back to our top story. President Trump has departed the G7 summit a day earlier than planned.
Why are you leaving the G7 early for Washington?
Well, I have to be back. Very important. You probably see what I see, and I have to be back as soon as I can.
French President Emmanuel Macron suggested that the move was to broker a ceasefire between Israel and Iran. But President Trump took to Truth Social, saying he was working on something, quote, much bigger than that. And just moments ago, the president speaking to reporters on Air Force One, saying that he is not too much in the mood to negotiate with Iran. Joining us now for more is Bloomberg's Susan Lynch. Suzanne, what do we know about why Trump departed early?
Well, we know that Donald Trump shot down Emmanuel Macron's suggestion that he was going back to Washington to broker a ceasefire deal. Donald Trump was very clear in his Truth Social post that that was not the case. He said something much bigger. So there are now obviously a lot of speculation about what might be happening in Washington. Would there be some kind of U.S. involvement? We did hear, though, from the U.S. Defense Secretary on a media interview, that they still want peace. But the world here in Europe are waking up to this development overnight. There is concern about what this means now for what's happening in the Middle East in this ongoing and escalating conflict between Israel and Iran.
Suzanne, there's been so much back and forth as to whether the U.S. is, in Trump's word, not too much in a mood to negotiate or negotiate. There was some reporting from Axios on a potential meeting between Steve Witkoff and the Iran foreign minister. Iran itself asking for de-escalation, at least sending those signals. Does it seem like there is a white flag? Will the U.S. listen? Are there underway, does it seem, any negotiations to get something like a ceasefire?
Well, there did indeed to be some signals from Tehran of some move towards or desire for de-escalation. Obviously, we saw those attacks in Tehran yesterday. This reporting from Axios does suggest that some kind of negotiations could be in the offing from the US side. Donald Trump spoke about the need to not just talk over the phone, talk in person. So perhaps there is some kind of background manoeuvre on this. We know that Donald Trump says that he is the deal maker. He wants a deal. The big question now is he prepared to get involved at this kind of granular level in a deal between Israel and Iran? That's what everybody is asking now. But the very fact that he left the G7 summit in this nature is extremely significant. People were not expecting that. Now, in one way, I think the other partners around the G7 table will be relieved that he did sign up to the declaration calling for de-escalation. It wasn't like the last time we had a G7 summit in Canada, which ended in acrimony after Donald Trump left. This was different. There was a different reason, as he said, that he left. So from that point of view, I think the international allies of the United States will be relieved.
Yeah, the Deutsche Bank pointing out that the G7 leader statement this time was only 121 words. The last one was over 19,000 words, just confining their statement to Israel, Iran. Suzanne, thank you so much for that excellent coverage, Suzanne Lynch. Now, Mark Dowding of RBC Bluebay stays cautious on risk around the Israel-Iran conflict, writing, quote, at a time of some market complacency, the Middle East and geopolitics more broadly is a source of risk which we cannot ignore. Joining us now is Mark Dowding, CIO Fixed Income of RBC Bluebay Asset Management. Mark, just how fat is that dangerous tale of risks we might see as we head deeper into this conflict?
So I'd say here that in many respects, if you look at financial market movements on the back of the conflicts between Israel and Iran at this point, everything has really been relatively muted. I think that there would have been a point in the past when, if you'd have told me that we'd see a war between these two nations, you'd be sort of half expecting oil to be up at a figure like $150, or you'd be expecting to see a big risk-off move across financial markets. We haven't seen that, of course. Oil prices remain very contained, and at the moment, it seems that the majority review is that things stay contained as they are. But in terms of the fat tail, that fat tail is something that you still need to ascribe a 10 to 20% probability towards, I'd suggest, and it could be that the markets get stung there if things do end up escalating in an unpleasant way.
Mark, should markets be prepared for that, though? Because as you say, they've been really sanguine. Is it a moment of complacency?
So I think that something we see more generally is that in a climate of great uncertainty, markets are really struggling to price in multiple scenarios. In a way, you end up with too many scenarios on trade, on geopolitics to effectively analyze all in one go. But I would say that if you sort of look at what is priced here in markets at the moment, with stocks close to their highs, you'd actually say that at the moment, risk assets continue to climb the wall of worry, don't they? It's like buy every dip, everything keeps on going up for the time being. But in the here and now, I would say that it makes more sense to me to favour a more cautious stance and then look to be in a position to add risk if markets do blow out, rather than be chasing price action and chasing the run up in risk assets at this moment in time. So from that point of view, we've been more inclined to actually de-risk portfolios. Yeah. We've been inclined to actually put on portfolio hedges over the course of recent days.
Have those hedges including duration, Mark? Because the move has been anything but straightforward. In that initial gut punch reaction of risk off, we did see Treasury yields move higher. How do you understand what's driving them and what your appetite is for them if you are looking at getting more defensive?
Yeah, so here I would suggest that there has been times in the past where using duration as a risk-off hedge has been a strategy that's worked. We're not so clear right here, right now, that using duration in that way is actually the best way to actually hedge some of those risk-off events, particularly because some of the scenarios that could actually take yields risk-off would actually be scenarios that could actually see long-dated debt yields moving up, not down. We actually think that a curve steepener is a better way to actually use fixed income assets to actually run a risk-off hedge. Most scenarios in our mind, as we would model them going forward from here, point very much towards a steeper US yield curve. And so in a portfolio context, we think that this is the thing that investors should really be bearing in mind.
All right, so it's a different regime. I'd also love to get your take, Mark, on a Christine Lagarde FT quote that we saw, not a quote, rather, a opinion piece in the FT. By the way, we are just seeing the president exit Air Force One as he leaves the G7 early. But Christine Lagarde writing that this is a moment for change, an opportunity for change for Europe. It is a global euro moment. To seize it and enhance the euro's role in international monetary system, we must act decisively as united Europe, taking greater control of its own destiny. Mark, we have seen the U.S. dollar continue to weaken. There have been calls as to what takes its place, if anything can take its place. Christine Lagarde actively campaigning for this to be the moment for the euro. How likely or unlikely is that?
Well, I'd say that they are big, beautiful words, aren't they, coming from Mrs. Lagarde, just as I look at the big, beautiful guy sitting in the back of his car there. But the problem for Europe is we need action, not words. Mario Draghi last year was calling for an agenda for change for the EU that I'd very much endorse. I think contained a lot of the right ideas. But investors want to see the substance behind these words. The problem with Europe is it can be a bit too much talk, not enough action. And now is the time, I'd suggest, to see action, substance more than words. So let's see European leaders get this done. Let's see them make sort of steps towards developing the single market sort of union and the financial union and all of these steps which are in their hands, rather than just trying to talk a good game all the time.
Well, Mark, we didn't even have time for the other big, beautiful thing, which is the big, beautiful bill. We'll have to get around to that next time. We're out of time. Thank you so much for joining us, Mark. Always great to get your comments. Mark Dowding of RBC Bluebay Asset Management. Let's get you some other top stories that are trending on the terminal this morning. The U.S. and U.K. have reached an agreement to implement trading terms disclosed last month that would slash tariffs on British products and raise U.K. quotas on certain U.S. agricultural products. Duties on British exports will be down to 2% from 27.5%. The deal did fall short of an immediate cut to steel tariffs. And speaking of the big, beautiful bill, Senate Republicans have proposed to cut trillions of dollars in taxes for households and businesses in their version of President Trump's tax bill. It would preserve the 2017 tax cuts, but cut Medicaid benefits and add to the U.S. deficit. Notably absent from the bill, a deal on state and local tax deductions. Cantor Fitzgerald has hired about 15 investment bankers and traders in Germany. The bank, run for decades by Howard Lutnick, is looking to push deeper into European markets. Representatives for Cantor declined to comment. Coming up, we're live at the Paris Air Show with Virginia Governor Glenn Youngkin. That comes up next. This is Bloomberg. It's your Bloomberg Brief. I'm Danny Berger in New York. Let's now head over to the Paris Air Show, where Bloomberg's Guy Johnson joins us live with the governor of Virginia. Good morning, Guy.
Glenn Youngkin is here. I nearly got that out in one go. Good morning.
Good morning. Thanks for having me.
We sit here at the Air Show, and I talked to you about this over the last few years. This is a really integrated industry, okay? A lot of the companies that are here are headquartered in your state. A lot of Virginians are here. But it's a really integrated, this is a global industry. It's not a Virginia industry, it's not an American industry, it's a global industry, the aerospace industry. And a lot of people here are scratching their heads, wondering, therefore, what happens next in terms of trade? Can I continue to manufacture the aircraft that I manufacture with US parts in them and European parts in them? Do you think there should be some exception made for this incredibly complex, different industry that we see behind us here?
Well, there's historically been arrangements around the world. Yeah, big agreements. I think one of the challenges that we're working through is how much of the content is in what countries and who's buying. And so I think that the next step here is first to understand the mapping of all those supply chains, and then second of all, to see whether there can be an agreement that's reached. At the end of the day, I've been very supportive of the president's position that we need fair trade. And historically, across all the industries, the United States has really been in disadvantage around the world, with trade really being imbalanced. And so he's rebalancing these trade agreements. The result of that we're seeing in the Commonwealth of Virginia, where so many companies now are coming to establish U.S. manufacturing. And the good thing is they're choosing Virginia to put it down. We've had $100 billion of commitments from companies to build and expand in Virginia, and we expect to continue to see that. So this long-term agreement that has existed in aerospace for a long time, I think will be something that will be addressed. But at the heart of it is rebalancing some of these trade agreements.
But this is a reasonably nuanced story here. This is an industry that is quite balanced. Boeing, headquartered in your state, exports a lot of aeroplanes around the world. You wouldn't want to see that put at a disadvantage, that company put at a disadvantage, Kelly put at a disadvantage when he tries to sell aeroplanes around the world, would you?
Well, it's a matter of balancing around the world. And if we have open trade agreements with our partners, much of this is done on a bilateral basis with the current administration, then it'll settle out. And if we have certain partners that aren't willing to do that, then it'll be more difficult.
Do you think it's reasonable? It appears at the moment that if you buy lots of Boeing, headquartered in Virginia, that you get a good trade deal.
Yes.
Is that a reasonable kind of thing to talk about?
Yeah. If as an American, yes. I mean, I think one of the real opportunities is for America to recognize, and this is exactly what President Trump is doing, is that access to the U.S. market is really important to companies around the world, and we want fair trade with all of our counterparties. And to date, it has not been very fair, and so they're rebalancing that. And I think this is exactly what all the industries are seeing today. And we hear the same thing in the automotive industry and others, that it is complicated in supply chains. Well, over time, as things settle down and we can see President Trump reaching deals like he's reached with the UK, that we will see fair trade. And when that fair trade is set, then we'll see industries like the aerospace industry settle into it.
Let's talk a little bit more about Boeing, headquartered in Virginia. Makes a lot of aeroplanes in Seattle, though. And I'm wondering whether or not increasingly there is an argument that says Boeing should be headquartered in Seattle, in Washington, not in Virginia. Can you kind of see the logic of that?
Well, I also see the logic of their very, very large customer being the Pentagon, which happens to be in Virginia. And where they had a huge win just recently as the prime on the new F-47, which is the next generation fighter for the military. And so what I think what Boeing has recognized is that, one, they have the best workforce in the world in Virginia, and so they tap into that for all of their corporate functions. They have great access to their customer. And I know that the flights from Dulles to Seattle are busy as their senior executives move back and forth between Washington and Washington.
Yes. Yeah. Just confusing for the rest of us.
Yeah.
But isn't there an argument that says you need to be close to the shop floor? Yes, the customer is at the Pentagon, but the lesson we've learned is be close to the shop floor.
Yeah, well, so I spoke to Kelly when he came on as the new CEO, and we had this very candid discussion, and he said he was very comfortable with the headquarters being in Virginia, but he personally was going to spend an enormous amount of time with the commercial aerospace business as he set that right. And that's exactly what he's done. And yet their defense business has been growing, not to mention the fact, again, that this F-47 win is a big one for them.
Okay, you bring up defense, so let's just kind of talk about defense for just a second. Again, it comes back to the same argument. Should Europe be buying more U.S. defense in order to balance the books?
I think the U.S. defense industry would very much like for them to.
Sure, but is that a way to get over the trade disagreement that we have at the moment?
I think it's one of the tools in the toolkit, once again, to balance the trade. And when you have large trade imbalances, where we are in fact buying a lot more in the United States from countries than they're buying from us, it's one of the tools in the toolkit. And I do think that the defense military complex has the most advanced military capabilities in the world. And so I think that what we're seeing is the collaborations between U.S. companies and particularly European countries, I've had a lot of meetings in the last 2 days, has never been better right now. And in fact, what I think is happening is the European and international companies are really moving into the United States with breakneck speed. Because what they're hearing from the Pentagon is we want to do more and we want to do it faster. And so we need more robust supply chains that can deliver what we need faster. And a lot of the international companies are starting to come into the United States, either through a proxy arrangement or with partners in order to try to meet that demand.
Before I throw it back to Danny, you're term limited. A cabinet job maybe next year?
I'm going to finish strong in Virginia, and then we'll see what happens. I think one of the great things that I have realized is I don't need to worry about this every day. I'm focused on the Commonwealth. And Virginia is really roaring. We've just touched through $100 billion of capital commitments from companies. We have more people working than ever. We're running our 4th straight year of another big surplus, which is allow us to reduce tax burdens and make big investments. The state's doing extraordinarily well, and I've just loved the job I've had, and I can't wait to finish strong. And so I've got to do that over the next year.
Balanced budgets, they're amazing things. Glenn, great to see you. Governor, thank you very much indeed for joining us.
Great, thank you.
Governor Glenn Youngkin of Virginia. Danny, back to you.
Guy, thank you so much. A fantastic conversation. Also, just want to bring you some breaking lines from the president saying he has not reached out to Iran for peace talks. If Iran wants to talk, they know how to reach me, and reiterated that they should have taken the deal on the table. We'll have more coming up on just that. You're watching Bloomberg Brief. Let's take a look at the front pages this morning on the biggest outlets. First up, the FT, and indeed most papers leading with President Trump leaving the G7 early in Canada to manage America's response to Israel and Iran on Air Force One. Coming off of it, he said, I have not reached out to Iran for peace talks. If they want to talk, they know how to reach me. Next up, the Washington Post also has this on their front page: Russia launching a deadly attack on Kyiv. At least 15 people, including an American citizen, were killed and more than 100 injured. This is Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Tuesday morning. President Trump cut short his G7 visit while calling for an immediate evacuation of Tehran. Those comments rattle markets, stocks dip, and oil jumps as the Israel-Iran tensions persist. And readying for a slog, Senate Republicans released their blueprint of the big, beautiful bill, deepening a rift with the House's version. Without escalation yesterday, it was a climb in stocks just 2% away from all-time highs. That changed last night with Trump leaving the G7 early, convening the National Security Council. We are lower by more than 0.5%. Trump on Air Force One this morning saying that he is in no mood to negotiate with Iran. So those de-escalation hopes quickly getting squashed in markets. That's also translating to higher oil prices this morning, higher by more than 1%. That move almost exactly mirroring the drop we saw yesterday, leaving oil unchanged on the week. But we are finally getting a bid into bonds. 2-year yields lower by 1.6 basis points. Your 10-year yield lower by about 2. We had a solid auction yesterday on the 20-year. Let's get some stocks that are moving in the pre-market. With that is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So solar energy stocks really hit hard this morning, and it is that update on the big, beautiful bill coming out of the Senate last night. We're seeing Sunrun, Solar Edge, Enphase, First Solar, all down double digits this morning. Sunrun down 27%. The bill from the Senate Republicans set to end tax credits sooner than expected. Potentially, they're going to end by 2028, really spurring some fear in the market for solar stocks today. Then over in telecoms, we've got T-Mobile weaker as SoftBank looks to offload potentially a big stake in that company. They're looking to move some of those funds into AI, much more on trend than the telecom space. That stock down almost 4% for T-Mobile today. Then over in pharma, gene therapeutics, something that I'm not afraid to admit I don't know a lot about. It is DNA editing, and according to the Financial Times, Eli Lilly looking to get into this space via a takeover of Verve Therapeutics. Now, this is worth around $1 billion or so more in terms of the deal size. That stock soaring 80%. We'll probably struggle to see a bigger gainer than that today. Verve Therapeutics soaring on that report of an Eli Lilly takeover. Danny.
A big move this morning, Joe. Thank you so much. Now back to our top story. Apollo's Torsten Slok pointing out that the Fed's own model shows that a $10 jump in oil prices feed through to a 0.4% drag on GDP and a 0.35% increase in inflation. He writes, in short, higher oil prices exacerbate the ongoing stagflation shock stemming from tariffs and immigration restrictions. I'm pleased to say that Torsten joins us now. So Torsten, just another added risk to that tension you're talking about. How close are we to a Fed that is going to have to choose between its dual mandates?
Yeah, this is a really important debate for tomorrow, Danny, because at the moment the Fed is stuck with a dual mandate that's really torn. On the one hand, the upside pressure on inflation from tariffs, from oil prices, from restrictions on immigration. That's saying that inflation will be going up, and that's their forecast. That's also the consensus forecast. And if inflation is going up, the Fed should be hiking. But at the same time, those shocks also will be pointing in the direction of growth slowing down. And if growth is slowing down, then Fed should be cutting. So which one is it? Is the Fed putting weight on inflation going up? Or are they tomorrow putting weight on growth slowing down? So that's why the combination of the things that are hitting markets at the moment, with in particular, of course, now oil prices also going up, but coming on the back of that, also, of course, tariffs higher and also restrictions on immigration. It does put the Fed in a very difficult spot going into the meeting tomorrow.
The Fed, of course, though, can only react to the data that's coming in, Torsten. So how much does sequencing matter here in terms of what really starts to hit the economy first, inflation or growth slowdown?
Yeah, that's really exactly the point, namely that it all, from their perspective, is about let's see which one moves first. So, yes, the forecast that they have says higher inflation and lower growth. The forecast the consensus has says higher inflation, lower growth. But we don't know which of these will appear first. So far, inflation has been reasonably well behaved. Growth has also been okay. There's been some signs of jobless claims ticking higher. And there's also been a little bit more worrying signs of continuing claims moving higher. Continuing claims moving higher is particularly worrying because it suggests that corporate America is frozen. That corporate America, they're not hiring, they're not firing. And as a result of that, we should see the stock of people that are unemployed continue to edge higher. And that's what we've seen in the last few weeks. And combining that with today retail sales will also be telling us something about is the consumer also in the process of slowing down. And we have the weekly data from Redbook, same-store sales has been slowing down in the last few weeks. So the fear here is that growth starts slowing down and at the same time inflation goes up. And that makes it difficult for the Fed then to figure out at this point which of these things are exactly going to move first.
Torsten, you spent a lot of time thinking about what could go wrong. That is slowdown, consumers pulling back, inflation ticking up. What could go right this year? Could things go right for the Fed and get the good kind of cuts because inflation is slowing, even with growth holding up?
Well, and let's add also to the list of things that could go wrong that we, of course, also have issues around treasury auctions, worries about fiscal issuance. We also have worries around who the next Fed chair will be. So in that sense, there's a number of things, of course, that are the list of things that markets are monitoring and that we spend a lot of time on here at Apollo. But the short answer to your question is, what could go right is, of course, if we do have oil prices beginning to go down, if we do have a lowering of tariffs, and if we do have that rates are no longer going up as much because of the fiscal situation. So it's almost a negative sign, if you will, on all the things that we worry about, that those risks, if they begin to move in the right direction, then I do think there would be some relief. But let's wait and see, especially with retail sales out here in a few hours. It becomes very important what the consumer is doing. The consumer is still 70% of the economy. And if the consumer is still doing well, then, of course, that would also be, at least for now, a relief for markets.
Yeah, last month was, let's say, uninspiring at best. Torsten, you mentioned fiscal. When it comes to the big, beautiful bill making its way through Washington, how do you interpret what is reckless spending and therefore an issue versus stimulative to the economy?
Yeah, so as Jay Powell says, every time he talks about this, fiscal policy is unsustainable. And of course, when fiscal policy is unsustainable, the ultimate fear is that long rates will go up and the term premium will go up and the curve will steepen. And therefore, it becomes more difficult for the Fed to control the economy in the front end because the long run is no longer measured running only by what's happening with inflation, but now the long end is also driven by what's happening to the fiscal issues. So in that sense, more debt means higher rates. At the same time, as you're saying, well, if there is more fiscal expansion, we will, of course, see some boost to GDP. So on the one hand, higher rates is dragging GDP down. On the other hand, the fiscal boost to GDP, which will only probably be 3 or 0.4% over the next 2 years, but that is, of course, something that would be helpful. So in that sense, we will likely get a boost to the economy from the fiscal bill here in the short run, but it remains, of course, the case in the back end of the curve that there is still a lot of questions being asked about what is the impact of the fiscal situation over the coming months ahead as a result of debt levels growing so much.
Torsten, I just want to end where we started. And we're in this environment where there's been a tariff blitz. Oil prices have been jumping. We see freight rates continue to be high. Is this an environment and an economy that cost shocks are back, that we are sensitive to it?
That's exactly right. And that's why the best description of what's going on is that the economy is hit by stagflation, because stagflation is coming because of higher prices, because of tariffs. And when prices go up in companies, of course, then sales will go down. Higher prices coming because of oil. And when oil prices go up, of course, we buy less oil. And finally, also higher prices going up because of restrictions on immigration. Wage inflation in the last employment report was going up. And ultimately, if wage inflation go up, of course, it also runs the risk of lowering employment. So stagflation hitting the economy is what makes it so difficult for the Fed in the meeting tomorrow, because the Fed has this risk that if they put too much weight on inflation, and the dot plot to some degree reveals that the next move in their view will be a cut. So therefore, let's say that they do begin to cut, and especially if they begin to cut more meaningfully, then the risk is, of course, that inflation might begin to move higher, and that's when the dual mandate here, torn in different directions, is really complicating the thinking for markets and for the Fed at the moment.
Certainly be interested to see how he threads that needle tomorrow. Torsten, so great to hear from you this morning. Torsten Slok of Apollo Global Management. By the way, we quickly want to bring you the Global Investor Survey from Bank of America is out. Investors are net 31% underweight the U.S. dollar. That is the most in 20 years. Let's get you some other top stories now that are trending on the terminal this morning. The U.S. and U.K. have reached an agreement to implement trading terms disclosed last month that would slash tariffs on British products and raise U.K. quotas on certain U.S. agricultural products. Duties on British exports will be down to 10% from 27.5%. The deal fell short of an immediate cut, though, to steel tariffs. Barclays has hired McKinsey to simplify its investment bank and identify hundreds of millions of dollars in potential savings. Bloomberg sources say the consultants are looking into the front office, finance, risk, and technology divisions and opportunities for automation. Elsewhere in banking, Cantor Fitzgerald has hired about 15 investment bankers and traders in Germany. The bank, run for decades by Howard Lutnick, is looking to push deeper into European markets. Representatives for Cantor declined to comment. Coming up, President Trump says that he has not reached out to Iran for peace talks after cutting his G7 trip short. We're going to have more on that next on your Bloomberg Brief.
I've been negotiating. I told them to do the deal. They should have done the deal. The cities have been blown to pieces. We've lost a lot of people. They should have done the deal. I told them, do the deal. So I don't know. I'm not too much in a mood to negotiate.
President Trump speaking on Air Force One moments ago after he left the G7 summit early. The president also took to Truth Social, reiterating that he hasn't reached out to Iran for peace talks after he earlier denied that suggestion from the French President Emmanuel Macron. There was also some reporting from Axios this morning that Steve Witkoff would be meeting potentially with the Iranian foreign minister. So Trump potentially reacting to that, too. Joining us for more is Bloomberg's Horizons Middle East and Africa host, Jomana Bersecci. Jomana, what do we know about why Trump left the G7 early and what it means in this ongoing conflict?
That's right. So we woke up to a flurry of headlines, the main one being the fact that President Trump decided to leave that G7 summit early. Later, the rationale given behind it was that he wanted to focus on the latest developments in the Middle East. But he then downplayed the prospect of reaching a ceasefire there in response to some comments that the French President Macron had made that there could be a possibility of a truce. Trump went on to say that they're working on something much bigger than that. And as we were just showing, the Air Force One just landed back in the U.S. and he said that if Iran wants to talk, they know how to reach me. They reiterate that Iran should have taken the deal that was on the table. And so this really is a critical moment because the whole world is waiting to see what sort of involvement the U.S. is going to have in the events that are unfolding. On Sunday, President Trump said that quote, let them fight it out and see how things play out, i.e. more of a spectator role. Today, he's raising the possibility again of a potential to restart those nuclear discussions. Remember, the round 6 of those discussions were supposed to take place in Oman on Sunday. They were cancelled, but now he's talking about the possibility of re-engaging diplomatically. And then, of course, the third option would be for the U.S. to get militarily involved and to join Israel in those airstrikes on some of those key strategic locations, the ones that we've been talking about, both those nuclear sites and the military sites as well, with Israel and the Israeli army saying militarily the last 24 hours, they feel like they are in a very dominant position. Now, the situation is very tense on the ground, and we also need to dovetail all of the headlines that I was just giving you now versus the other post that President Trump put up overnight warning Tehran residents, and by the way, there are 10 million residents in Tehran, to evacuate their homes. The airspaces are closed. They're going to be closed until 2 a.m. morning, another extension. There's nowhere for these residents to go. Traffic's miles long. People are trying to flee up to the mountains. So a very precarious and tense situation right now in the Middle East as the whole world waits to see what the U.S. are exactly thinking here.
Joanna, thank you for your excellent coverage all this week and last. Joanna Bersecci there. Over in Washington, President Trump's tax and spend bill still in the Senate. For their version, Republicans are proposing to cut trillions of dollars in taxes for households and businesses at the expense of health coverage and at risk of expanding the deficit with no deal on salt. Joining us for more is Bloomberg's Suzanne Lynch. Suzanne, great to see you again. Just how much daylight is there between the Senate and House versions of the big, beautiful bill?
Quite a bit, and this really matters because it does have to get through both houses before it gets to the desk of Donald Trump under that self-imposed deadline of July 4th. So the Senate has made a number of changes, including those deeper cuts to Medicaid, and already we've seen some Republican senators, like Josh Hawley, for example, who are not happy with that. So there is still some gaps to be filled. The other issue is, of course, how it's going to add to the deficit. We're now looking at around $5 trillion, so that's a huge amount. What we didn't have is a big change to SALT, those local tax provision with the credit still at $10,000 in the Senate version. That's kind of a placeholder. It could change. But yes, there is quite a bit of daylight between those two versions as they stand.
Suzanne, what does it mean in terms of where things go from here? Just how much of a slog it could be to pass this bill?
Well, I think the House Speaker made it very clear that this was a very tight vote in the House and urged Senate Republicans not to go too far, not to change it too much. You know, the Senate, it's going to come down to around 3 votes. The House passed its version by just 1 vote. So this is going to be very tight. And this really does matter for Donald Trump, for his presidency. We've been hearing and discussing, of course, about these big international challenges. But domestically, this is the big signature move by Donald Trump. Will those 2017 tax cuts, will they be extended as is hoped by Donald Trump and Republicans when they're set to expire by the end of the year? So a lot riding on this.
Suzanne, thank you so much for that this morning. That is Bloomberg's Susan Lynch. Let's now get you a Bloomberg exclusive. Sonali Basak sat down with the Citadel founder and CEO Ken Griffin for a wide-ranging interview. Here's what he said on political support.
One of the big pushes that we made over recent years was to substantially increase the number of people who ran for office in the Republican Party who were women, who were veterans, and who were people of color. Because I believe the Republican Party needs to do a better job of representing all of America. So that's been a big push for us over the recent years, has been bringing people with those backgrounds into public service. You know, I was an adamant supporter, for example, of David McCormick. Really strong businessman, really great experience in serving our country. That's the kind of person that I want to see in Washington representing the interests of all of us who live in our great country.
More on that interview on Bloomberg Originals Bullish with Sonali Basak. And I'm so pleased to say Sonali joins us here ahead of the premiere tonight. Sonali, really fantastic interview. I know you have so many more fantastic ones to bring us. really wide-ranging with Ken. What were some of your takeaways?
The political takeaways I thought were the most interesting, because when I asked him how he wants to leave his mark on the Republican Party, he made pretty clear that he's not just a Republican donor. Now, that could most be seen in the way he supported the South Florida area. For example, the Miami-Dade mayor. In addition to the Miami mayor, there's a Democrat and a Republican. But also the idea of shaping the Republican Party with more diversity, frankly, with more women, with more veterans, with more people of color. He gave a nice little shout out to David McCormick to kind of show what he thinks the future of the Republican Party is. Now, also interesting here, if you read very much to the bottom, you can hear more about his investing advice also, as well as his stress relief techniques, which are somewhat surprising for Ken Griffin, but I'm not going to give it away. I'm going to let
I was going to say,
read.
I need to know. That's a good tease. That's a good tease, Shonali. Speaking of teases, I know you're speaking with Nassim Taleb later today, too, who also appears on Bullish. What are you going to talk to him about? What does he talk about in the show?
Listen, when we spoke to a lot of these large investors for the course of creating Bullish, we were looking for the intersection of money, politics, culture. So we went to South Florida and Universal Investments, where Nassim Taleb is a scientific advisor, is based there. He talked a lot about the shift away from the banking system into the non-bank system, the kind of risk but also opportunity it poses. The last time we spoke to him also for this series, which airs at 6 p.m. tonight, he talked a lot about that DeepSeek moment, and he said that it wasn't over. So we will revisit that with him today at 10 o'clock.
Again, you spoke with so many banking luminaries. Was there any big takeaway in terms of this moment? We've seen volatility, shock after shock for this economy. How are they adapting to this very different time we find ourselves in?
Some of them are pulling out the old playbooks. For example, episode 2, a little bit of teaser for the series as well. Next week, we'll have Boaz Weinstein. And we taped with him, I believe, the week of Liberation Day. So to hear a little bit about how these luminaries are investing through volatility, you might remember Ken Griffin said he wished he held cash. But like Boaz, Nassim also works very closely with the tail risk fund. And so my big question is, how long will kind of the old techniques work for? Something they're all still watching out for. I'll use Ken Griffin's words on the tariffs in particular. It's not just whether this is going to become a regressive tax on the larger American society, but what it means for the midterms. A lot of people are already looking ahead to see how much the politics will change near term if you can look past the shorter horizon on the tariff negotiations.
Shonali, I know we're really all excited for the debut. 6 p.m. tonight, Bullish, and now we have to watch because we need to know what Ken Griffin's relaxation tips are. Just another reason to watch. You already should be anyway. Shonali, thank you so much. Again, the premiere of Bullish with Shonali Bassick airs tonight, Bloomberg TV at 6 p.m. New York time, and streams on Bloomberg Originals at 8 p.m., a show you do not want to miss. Coming up, we're going to get you set up for your trading day, some economic data on deck with retail sales. We'll have your trading diary next. This is your Bloomberg Brief. You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Tuesday. We're going to get U.S. retail sales. That comes at 8:30 a.m. Eastern. That will be followed by the NAHB Housing Market Index. That comes at 10 a.m. It's also day 2 of the G7 summit in Canada. Of course, day 2 will take place without President Trump. Some individual movers for you this morning, moving in the pre-market session. T-Mobile, those shares falling more than 4%. There was a report that SoftBank raised close to $5 billion through a sale of T-Mobile shares. The idea of that sale pushing for AI for SoftBank. Enphase Energy, along with other solar stocks tumbling, this one down 16%. The Senate bill blueprint showed an earlier end to the tax credit for the clean energies, and Verve Therapeutics soaring 81% or almost 82% this morning. There's a report of a $1.3 billion Eli Lilly deal. Let me quickly show you what oil is doing, because we've done a round trip. We are unchanged nearly on the week, because yesterday we saw this big decline in oil. This morning we are undoing it with Trump leaving the G7 early, saying he is in no mood to negotiate with Iran. There had been hopes of something of de-escalation, of a ceasefire. At least that was the word from the Wall Street Journal, reporting that Iran had been bidding for that, appealing to its allies, saying to the U.S., we will have nuclear discussions if you help us with a ceasefire. We'll have more of that coming up. Surveillance up ahead. That's it for your brief.